Hello class, and welcome to Financial Modeling in my home office. So I'm going to cover two things today. I will quickly summarize the case that you all have sent me. I just want to make sure that we all are clear on what we're doing so that we do well on the next test, which will be next week. And the second thing we will do is I will explain additional funding needed, or the AFN equation. First of all, so I've written here sort of a list of to-dos for your model. First thing, you project the 5 years of the financial statements, balance sheets, and income statements. And from this time forward, we are using short-term debt, a line of credit, to balance the balance sheets. Now, for the past case that you all did, you needed a line of credit for 3 years of the 5 years projected. Then we had extra cash, and the company then had short-term investments. And to keep it somewhat simple, we're saying no interest on the short-term investments. Okay, once you have item 1, item 2, project your free cash flows for 5 years. Remember, investments are one of the uses of free cash flow. So the whole idea of a free cash flow is extra money that a company has that they can either pay down debt, buy back stock, pay dividends, pay interest, or make investments. It is actually extra money. So when you calculate your free cash flow, make sure that you exclude from operating assets any investments. Third up, calculate the weighted average cost of capital, which is the cost of any interest expense times 1 minus the tax rate plus the dividends, divided by all of the debt and common and preferred stock for the last year, year 5. And also calculate for year 5 the growth in free cash flow between year 4 and 5. And you're going to use the 5 years of your free cash flows in your model with the present value. You'll use your weighted average cost of capital and your growth rate. For the case that we all did, you should end up with a stock value of about $30 a share. I've written to most of you, I think I've written to all of you who've sent in the models, and I've given you feedback. Item 2. So, we'll erase this whiteboard, which was very nice, that our friends gave us or lent to me for my home office. So this is kind of a neat equation. Neat in that we can do it quickly. It'd be nice if I have a better marker. Let's try this one. AFN. Additional funding needed. So this is a quick way to calculate what a company would need to borrow on their line of credit. Now this is assuming that you're in a meeting, because again, if you did the full-fledged model, like the one I just talked about, you would be able to calculate it. But if you're in a meeting and people are saying, well, we want sales to grow by this amount of money, how much more will we need from the bank? That's why we have this formula. Now, there are some assumptions with this. First of all, we want to assume that we're operating at full capacity. This is a very important assumption, folks, because what it means is that whatever fixed assets we have, we are using fully. In other words, that if we need to increase sales, we will need to increase all of our assets, not just the current assets, accounts receivable, inventory, and cash, but also fixed assets. So we're operating already at full capacity. Secondly, that our assumptions about sales relative to assets stays the same. And that's pretty much based upon the fact that we're at full capacity. Third, for a new term, spontaneous assets, liabilities, spontaneous liabilities. The two spontaneous liability accounts that we deal with are accounts payable and accruals. So when sales go up, and as we've seen in our models, accounts payable and accruals typically go up by the same percentage, and those will stay relatively constant as well. And the fourth assumption is going to be that the profit margin stays the same. Remember, profit margin is net income divided by sales, and that the amount paid for dividends, that's staying the same as well. Dividend payout. So again, this is a quick way to calculate what additional funds are needed. So let me show you how the calculation actually works. So the formula looks like this. We're going to take what we have today, total assets divided by sales times the increase in sales. Sales increase. And then we're going to take that less the spontaneous liabilities relative to today's sales times the same sales increase minus the profit margin times total sales times 1 minus the dividend rate. And by the way, this is all in your book, Additional Funds Needed. So, let me give you some numbers to put with this to show you that it's not nearly as complex as it may appear. So let's just say that today total assets are $1.2 million. And sales are $2 million. The expected sales will increase by 10%. So the question is, what is going to be the funding that we need to support a 10% sales increase? Okay, so today total assets are $1.2 million. Sales today are $2 million. 10% of $2 million, and by the way, I'm dropping the zeros, 200. So that number, okay, spontaneous liabilities. Let's say that they're 8 divided by the same sales, 80, times that same sales increase, 200. And lastly, let's say that the company typically has a profit margin of 3%. Total sales for next year would be then $2,200,000. And let's say that they typically pay 25% out in dividends. That means they keep 75% of their money times 0.75. All right. We'll do the math. So $1.2 million divided by 2,000 times 200. 120. There's our first number. 120 minus 80 divided by 2 times the 200 minus 8. So again, if we only had the assets, we would need a full 120. But we have spontaneous liabilities, and we also have money that we will keep. That's what this piece is. So how much will that be? Well, we've got 2,200,000 times 0.03 times 0.75, 49 and a half, 49.5, I will call it 50. All right, so what will this company need? 120 minus 8 minus 50. So they will need 62. So if they want to increase sales by 10% and they have $2 million of sales, they will need $62,000 in order to fund it. So 120 minus 8 minus 50. And that is the second to last item we will have on our next test. So I will assign some homework problems, and as always, you can reach me by email. We can set a phone conference. Meanwhile, stay well, stay safe. I will talk to you all soon.